Hey everyone, welcome back to Corporate Decoder. Today we're diving into First Seacoast Bancorp's latest 10K filing. It's a long report, but don't worry, we'll extract the juicy parts. Let's just say it's a mixed bag, some good news, some not so good, and a few things that make you scratch your head. First Seacoast Bancorp Inc. is the holding company for First Seacoast Bank, a community bank serving the New Hampshire and southern Maine Seacoast region. Basically, they take deposits and make loans to people and businesses in their area. They've been around since 1890, so they're not new to this. For the year 2024, they filed an annual report on Form 10K, which covers business and financial performance. At the end of 2024, they had about $580 million in total assets, $439 million deposits, and $62 million in stockholders' equity. That's a lot of money changing hands. Their main business is taking deposits and using that money to give out loans, mostly for homes and commercial properties. They're trying to focus more on commercial lending to diversify their portfolio. The financial services industry is super competitive with big banks and smaller lenders all fighting for customers. First Seacoast faces challenges from bigger institutions with more resources and from online services that can offer lower costs. Competition for loans is particularly intense with other banks willing to lower rates just to gain market share. It's a tough game. Let's jump into the loan portfolio. 1 to 4 family residential real estate loans make up the biggest chunk at about 63% of their total loans. Commercial real estate comes in second at roughly 20%. They're also involved in acquisition, development, and land loans, as well as commercial and industrial loans, home equity lines, and some consumer lending. Looking at the loan portfolio maturities, a significant portion of the loans are due in more than 15 years, particularly in residential real estate. This means they're locked into those rates for quite some time, which can be a risk if interest rates change. They've got a mix of fixed and adjustable rate loans. A majority of their residential real estate loans are fixed rate, while their commercial real estate portfolio has a larger share of adjustable rate loans. Okay, good news here. Loan delinquencies are basically non-existent at December 31, 2024. This is a positive sign and means that their loan book quality is strong. Adding to that good news, non-performing assets were also nearly zero at the end of 2024. This is a big improvement. Now let's talk about the allowance for credit losses, or ACL. This is money set aside to cover potential loan losses. The amount they've set aside for credit losses actually went down a bit compared to last year. This could be a signal they are confident in the portfolio of loans or an aggressive stance. They consider economic factors, forecasts, and qualitative factors when determining their ACL. These factors help them predict how likely borrowers are to default. Now, onto their investment portfolio, they invest in things like US Treasury obligations, government-sponsored enterprises, municipal bonds, and mortgage-backed securities. These investments aim to provide liquidity, manage risk, and generate returns. One thing that has affected the company is that unrealized losses on available-for-sale securities have reduced the total stockholders' equity. During the year, they bought and sold securities to try and improve their balance sheet, hoping to boost returns. However, these moves also resulted in realized losses. Their investment portfolio is heavily weighted in US government-sponsored mortgage-backed securities. This is a pretty conservative strategy as these securities are generally seen as safe. The most important part of funding their operations is deposits. Deposits increase, but we're not that efficient. A significant amount of their deposits are uninsured, meaning they exceed the FDIC insurance limit. This could make the bank more vulnerable to deposit flight. Around 25% of the deposits are uninsured, which is pretty high. If people get nervous about the bank's health, they might pull their money out, which could create liquidity problems. The bank depends on borrowing from the Federal Home Loan Bank and Federal Reserve to make cash flow needs. They have 75 employees. The employees are not represented by any collective bargaining group, but the company does try to take care of their employees, which helps to keep good people around. As a savings bank, they're heavily regulated by the government. They have to follow rules about capital requirements, loans to one borrower, and community reinvestment. There are some requirements for a bank to be considered adequately capitalized, and that means to be safe. There is something called the Community Bank Leverage Ratio to allow qualifying banks to avoid complex risk-weighted asset calculations. The Dodd-Frank Act has created the Consumer Financial Protection Bureau, which has broad powers to supervise and enforce consumer protection laws. Cybersecurity is a big deal for financial institutions, and First Seacoast is no exception. They have a risk management program in place to deal with cyber threats, led by their senior technology, cybersecurity officer. It looks like the cybersecurity risk management processes for assessing, identifying, and managing threats are done and in place. They are not in a state where modifications are needed. They reported 0 loans modified. They state that they are not a party to any pending legal proceedings that we believe would have a material adverse effect on our consolidated financial condition. A stock repurchase program was authorized that allows the company to repurchase its shares. I would also be remiss to point out what they don't mention in this report, and that's the risk factor analysis. As a smaller reporting company, they are not required to give a detailed risk analysis, which makes our job harder and gives us less to talk about. Fault. Now let's wrap it all up. First, Seacoast Bancorp seems to be navigating a challenging environment. The community bank is seeing intense competition and volatile interest rates. They're working to diversify their loan portfolio and grow core deposits, which is a good sign. Their biggest challenge seems to be their high percentage of uninsured deposits. Also, while delinquency has decreased, the higher interest rates might be an issue. However, they do appear to have strong assets and a healthy lending limit, but they need to be careful about managing risk and keeping costs down. Overall, First Seacoast Bancorp appears to be at the mercy of their limited geographic market trends, and I would personally like to see a more diverse profile and lower expenses. Thanks for watching. If you found this analysis helpful, be sure to like, comment, and subscribe for more corporate decoder insights.